We hear people talking, we hear on the news all the time. If you're talking to your friends or family or coworkers, you might hear about how they made a bunch of money in a certain stock, and that really gets your greed meter going, and you want to figure out how you can get in on that. And so you look at this strategy of trading. Well, you hear about buying low and selling high, right? That sounds pretty easy. You buy a stock when it's low, you sell it when it's high. But then when you get into the reality of it, you find out that emotions are so hard to battle because, when you get in, there's fear on both ends. If you see that your investment has started to go down, fear might come in that, oh no, the sky is falling and I've got to get out. So you lock in a loss. You make what could be a temporary fluctuation in value to the downside a permanent thing by selling the investment. On the flip side of that, if your investment has gone up and you remember, oh yeah, I'm supposed to sell when the investment is high. Well, what if it goes higher? Then you get that fear of missing out, or that FOMO. When we enter into this discipline of investing, we're constantly fighting fear. We're fighting our emotions on both sides of it. So what we encourage, what our strategy is based on, it's a long-term strategy. We don't pay much attention, or we don't spend a lot of time trying to figure out what a particular stock or the market's going to do in the next 8 to 10 months. We're looking at the next 8 to 10 years. Back to that study that I was talking about, Morningstar released their study, and it's called Mind the Gap. It's a report on investor returns in the U.S., and it reveals that bad timing can cost investors 1/5 of their funds returned. So Morningstar is a company that compiles a lot of data on mutual funds. And in this year's study, they found that the average dollar invested in funds, mutual funds of all kinds, earned a 6% annual return over the 10 years ending December 31st, 2022. While the average fund gained about 7.7% over the same time span for a gap of about 1.7%. So hang on, what does that mean? So the fund, if you measure performance, if you're looking at their performance, you'll see that the average annual return was 7.7% for the 10-year period that ended at the end of last year. But the investors' return was only 6%. So what does that mean? It doesn't have anything to do with fees. All of this is reported net of fees. What it has to do with is the emotional component of it. It means that investors missed out on about 1/5 of their investment's average net returns because of timing. Getting in, getting out, all of those timing issues really impacted their return. So you might say, well, you know what, that doesn't seem like a whole lot of difference. I mean, 6% still pretty good if you're, a long-term investor. Here's what it means to your bottom line if you missed that 1.7%. If you had invested $100,000 10 years ago, year-end 2022, and you made 7.7% average annual return, you turned your $100,000 into $210,000. Now, if, on the other hand, you were like the average investor and you were, making moves to get in or out, and you only got 6% instead of the 7.7% that the fund returned, then your $100,000 only grew to $179,000. So that's roughly a $40,000 difference over a 10-year period that it cost you because you were trying to time the market or to time your investors. So the moral of the story is stick to your plan. Actually, know what your plan is first. You can't get spooked by short-term volatility because, on average, we have between 1 and 3 corrections of 5 to 10% per year. So if you're listening to the economic news, if you're listening to the market news every day, the market's all over the place. It's up one day, it's down one day, it has a winning streak, it goes on a losing streak, and you see the financial news start to jump on whichever direction it's moving. If it's going up, well, hey, the sky's the limit. Everybody needs to be in, and everybody needs to be, getting in on these great returns. If, on the other hand, it starts to shift, it's, this is that correction that we've been waiting for a long time, and now the sky is falling, and, you need to move to safety and all of those things. And, really what all of that does, if you listen on a regular basis and you don't listen from a framework of, hey, I know that in the short term, things are going to be volatile, but I'm not really that concerned about the short term because I don't need to spend this money for 8, 10, 20, 30, or maybe even 40 years. It makes no sense to lose your peace over what's happening in the market in the short term when you don't even need the money at that point.